the whole tariff situation is making volatility great again. I think there's just a major inflection point that we're sort of cycling in right now, and that is potentially the end of this AI tech trade.
Welcome to Rise Up at Wealthion. It's our weekly show to really dedicate ourselves to helping you understand what is happening in the markets and how can we work together to uncover smart investment moves as well as financial planning so we can help you grow and protect your wealth. I'm Terri Kallsen. I'm the co-host along with Joe Duran. I'm a managing partner at Rise Growth. Joe is the founder and chief investment officer at Rise Growth Partners. Welcome, Joe.
Well, thank you. I'm really happy to have you back. You know, I had to do the co-hosting duties. I'm definitely not as good as you. And look, you leave for a couple of days and the market goes straight down. So hopefully your being back is going to change things a little bit. But it's great to be back with you. Obviously, it's been a super challenging week since our last show. I can't believe, actually, it happens to be a coincidence. I wish we could tell you that we could predict these things, but we had Peter and Andy on with us, obviously talking about volatility. I think we had Scott on with us, Peter, talking about volatility, how to handle it, how to think about it. So as we go through, you might want to check out last week's show because we actually dedicated a whole segment. Our deep question was all about managing volatility, which would have been quite useful for this week, I guess.
Yeah, Joe, you know, you guys did a great job, Scott, Peter, and Joe. I watched it over the weekend. I was really excited to see it. And then I could think of lots of ideas to help you with your moderation. So we'll talk after.
Thank you very much.
If you'd like. But it is really great to have the gang back together. We've got Andy Schwartz with us, who is the founder of Bleakley Financial Group. He's a CFP. He's just been with us. He's just so much information in helping our clients. And then we have Peter Boockvar, who's the CIO, the Chief Investment Officer at Bleakley Financial Group, and writes the book, The Boockvar Report. So really great to have you guys here today.
Great to
and
see
obviously,
you.
Terri, we want to always have the smartest people in the world coming over to talk. And so we're really excited to talk about what's been happening this week.
That's right. Well, let's talk a little bit about the big three. If you can recall, we really want to talk about number one, the S&P. You know, as of close on Thursday, the S&P was down 1.59%. It's been down 5 out of the last 6 days. Maybe now that I'm back monitoring, we'll start to see some uplift. Who knows? But it's been a really time of fits and starts. Joe, what are your thoughts on that?
Hey, look, I think we're seeing two fundamental things play out here. I think the risk of stagflation has become a real thing. And I don't know that it's going to... Stagflation, for anyone who doesn't know, is very simple. It's the idea that your inflation is higher than anyone wants it to be. And we got some pretty, not bad readings, but they were worse than expected PCE reports. So inflation is worse than your target. We have a Fed that wants a 2% inflation rate. We're hovering now around 2.7, 2.9. And secondly, your growth rate, your GDP growth rate is less than you would like. So when you have higher inflation and lower growth, that leads to what's called stagflation. Now, again, it needs to be really high inflation and really bad GDP, like negative growth, to be officially stagflation. There's all kinds of cute things, blahflation, in-betweenflation. It's something in between. But clearly the growth aspect of it, inflation, I think, is not a surprise to people. But what you see with a 10-year treasury is that we're reflecting a growth rate that is not what people were hoping for. And we're starting to hear talk from companies in advance preparing for a slower earnings cycle. The second big thing that I think is happening is this tariff talk is a really big thing. And just overnight going from 10 to 20, and letting us know that we are, in fact, going to put the tariffs in Mexico and Canada. Think about what that means for all the US manufacturers, all the people who work globally, and figuring out what they're meant to do in a business sense, because we don't know if it's permanent, we don't know if it's temporary, we don't know what goods and products. So it has massive investment implications for companies, and they don't like to invest in uncertainty. So what they'll do is keep their powder dry and watch. And then we have one very important technical issue. We're clearly in a risk-off environment, and more importantly, a run away from the momentum stocks. It started, we talked about this last week, Peter, but it's clearly picked up steam. We see more of it every day. The conservative names, the healthcare names, the ones that you actually were recommending to people last week, that they're actually really, really being harmed. The S&P is being hit by the fact that all of these big Mag 7s represent such a big amount of the S&P, and the S&P is doing quite well underneath of that. But unfortunately, everything's being thrown out right now, but especially these momentum stocks. Peter, your thoughts? Am I off here? Do you have different opinions about what's happening in the market right now?
No, I think you hit the nail on the head. I mean, the whole tariff situation is making volatility great again. And you talked about the nominal fall in interest rates. We've only seen a modest fall in inflation expectations in the TIPS market. So that is sort of highlighting your stagflationary type situation in terms of being priced into the market. I think there's just a major inflection point that we're sort of cycling in right now, and that is potentially the end of this AI tech trade. This trade that so dominated markets since late 2022, early 2023, that sort of sucked all the oxygen out of the rest of the market, not only domestically, but internationally. So now you're seeing the pendulum beginning to switch to other things outside of the Mag 7, other things outside of the high multiple stocks into more value, and also internationally. You look at European markets, they're well outperforming US markets. Also, the Hang Seng Index in Hong Kong, well outperforming the US market. So this is a major thing because the whole world has piled into these big cap tech stocks. So it has a lot of relevance here to the broader market if this does continue. And then it begs the question of, does it drag down the whole market, or does it just pass the baton on to other things that can then start to lead the market if those stocks falter?
That's right. And just to highlight what you guys are saying, Trump is now saying that he's going to implement these tariffs on Canada as of March 4th. So that's next week already. And then he's going to increase tariffs on China by 10% and a potential 25% tariff on the EU. And so there's a lot going on, and a tariff on copper. So, data release, this is affecting consumer confidence. It's been the biggest drop in the last 4 years since August of 2021. And then we've got tax cuts, Trump's tax cut. How will they be extended? What's going on there? And then on top of that, Andy, I really want your input on this one. Charles Schwab recently on a traders poll said that most traders think it is still a bull market, even though 2/3 of them think that the market is overvalued. So what are you watching, Andy, and what are you telling your clients?
Yeah, I mean, so I don't think all assets are necessarily overvalued. Obviously, 50% of the return of the S&P has been the Mag 7 over a number of years, and those assets probably are overvalued. We're starting to finally see, our international value positions up 9% for the year, where the S&P is up, but maybe 1.5%. Actually, after today, probably somewhere closer to 1%. NASDAQ's negative or flat. So we are starting to see the value side, our value assets. We tend to have a little bit of a value bias. I looked at a bunch of accounts today. We're up 4.5% so far year to date on the value part of the S&P. I think Joe was saying before that if you take the Mag 7 out, even on the equal weight, although it isn't up as much as Joe was saying, if you took them out altogether, but even an equal weight, including them, it's positive. So everything isn't super expensive, but if you're just in an S&P 500 and it is market cap weighted, and if these stocks continue to come down, and clearly, we are in a risk-off trade environment. I know we were talking before about, Bitcoin, and lots of people think lots of different things about Bitcoin and what it is and what it is and what it isn't. I'm not sure 100%, but one thing I know it is a risk on or a risk off, kind of a trade. And we are in a risk off environment, and we're seeing, that asset class get hurt. Again, at the end of the day, we are in a crazy uncertain environment, and nobody likes uncertainty. The market doesn't like uncertainty. So one thing we advise clients to do is make sure that you know where your liquidity is coming from, at least in the near term. Because in an uncertain environment, we do not want to be in a position where we're selling equities as they're falling, needing them to handle liquidity needs. So that's really important, maybe more now than it has been for the last couple of years, to make sure we know where our liquidity is coming from for the next 12 to 24 months.
Yeah, and Andy, if our viewers aren't sure, that would be a great question to ask an advisor. Like, let's talk about liquidity during these times of volatility. So, Peter, you also sent over a really great article from the Wall Street Journal just this week. Top 10% of the wealthiest Americans are responsible for 50% of consumer spending. What's going on with that?
Well, it's something that we've been highlighting here for weeks now, is the very bifurcated consumer, where the lower to middle income consumer is still struggling with the sharp cumulative rise in inflation north of 20%, while the upper income consumer has handled that much better because it's their costs are much less relative to their income, and also they're benefiting from record high stock prices and high home prices. So the article really talked about that, and that the economy is sort of being held on its shoulders by that upper income consumer, with the top 10% of income earners making up about half of all consumer spending. That then ties into the stock market, because the stock market, in a circular way, the direction of the stock market from here can then flow through to that upper income spend and then determine where the economy goes in the rest of the year. Because the economy outside of upper income spending is only benefiting elsewhere in terms of benefits in AI spend and also government spending. And on the government spending side, now there's of course a lot of scrutiny on that. So if you get a pullback in government spending, you can see the fragility of the economy. While headline GDP looks at around 2.5%, underneath the hood, it's a much different picture.
That's right. And now let's go on to our big topic number 2. And Andy, you already mentioned it, Bitcoin, right? A lot of volatility in Bitcoin. Bitcoin is not having a good month at all. As of Thursday, the value was 84,298, and it's down about 16% this month. So it's been a really rough ride. Joe, what are your thoughts on Bitcoin?
Well, I have to say, I find it really amusing that for years, what we heard is Bitcoin as a store of value and as an alternative to gold. And we talked about this last week. Gold has actually done remarkably well. It was hitting new highs, where Bitcoin is acting very close correlation to NVIDIA and the Mag 7. If you look at Tesla and Bitcoin, you'll see that they behave remarkably similar, even though there should be no link at all. And so what we're learning now is that it's a risk asset. And when risk appetite goes out, it goes down. And so it is not a way to protect yourself the way gold can be. Again, as we said yesterday, when volatility goes high enough or the market falls enough, then the correlation of all asset classes becomes closer. And so again, I think we're going through a healthy correction, but Bitcoin is showing you it is not a place to hide when volatility is high. I also would say there's some fundamental issues. As I mentioned, I'd just been to El Salvador a few weeks ago. They had stopped using Bitcoin as their official tender because it could get hacked. It isn't secure. And Lord knows what we just learned by the North Koreans stealing $1.5 billion overnight, redirected, most of it untraceable. And what is that going to lead the US to do? Of course, increase regulation. And so we'll end up, I think we're going to talk a little bit about US stablecoin as an alternative. I think the technology that powers Bitcoin is really important, the blockchain. I am not sure that Bitcoin becomes the asset of choice because of situations like this. Rogue nations can use it. They then traffic it. They launder it. And I think you'll find that the big governments of the world who want to tax everything will say, we can't securely have something that is so untraceable, that can be used for nefarious means by bad actors. And we have a great example of it. So I think it wasn't the $1.5 billion or it's more about the long-term implications. But as a separate asset class, not only does it have some fundamental issues, and by the way, I'm a believer that Bitcoin should be for some people, something they invest in, but it should be a speculative investment. It is not a protective asset class.
Yeah, I like that. We're really learning a lot more about Bitcoin and how it performs in different environments. So, Andy, what are some of the things that you tell your clients about how much Bitcoin they should have in their portfolio?
Sure. Yeah, I mean, and look, Peter we've been talking about this together for a couple of years now. Bitcoin 2-3 years ago, we would refer to Bitcoin as digital gold. And we told clients, Bitcoin is not digital gold. Bitcoin can be a lot of things, but it is not digital gold. It is not necessarily a store of value. As Joe had just mentioned, it is much more of a risk on or a risk off trade. It trades like the NASDAQ, it trades like the most speculative, stocks. I mean, to us, if you think of it in the long term, a 1%, maybe 2% position as a speculative position, we're fine with, because who knows? I mean, but it's not a core position for a client's portfolio. And you've got to think of this long term, because maybe this thing does manifest into something, and maybe with blockchain technology and as it matures and becomes more steady, maybe it does look more like a currency. I mean, I know that there's some really smart people. Is it Thomas Lee talks about, he thinks it'll be at $1 million and, within 5 years. I mean, he's smarter than me. I don't know, but we would just say that we would be very cautious. It's not liquid. It's not digital gold. If you want gold, buy gold. If you don't want gold, don't buy gold, but don't buy Bitcoin thinking it's digital gold. So yeah, that's kind of our take on this.
Yeah, that's right. And meanwhile, we're starting to see some fast followers. The CEO of Robinhood, Vlad Teeny, said that this week he's confident that we could see a creation of a US dollar-backed stablecoin by Congress by the end of the year. What's the difference? And would this be a better investment than cryptocurrency, Peter?
Well, stable coins are, I mean, we have Tether, we have others. A stable coin is essentially a cryptocurrency that's backed by treasuries or other things that maintain that sort of $1 that someone would buy. So if I buy that stable coin for $1, the stable coin will be always worth $1, and then I can use that stable coin to buy other things. Can the US government create one? Maybe. I think that what will not be created by the US government is a central bank digital currency for privacy reasons. The US populace does not want the government to be tracking everything that we do. So I think mostly the stable coins that are going to pop up are not going to be government blessed. It'll be more private sector blessed, like Tether and like others.
But they are fundamentally different, Terry, because they're backed by actual dollars.
Right.
So this isn't like Bitcoin where, well, there's limited supply, and that's, even though there really, by the way, is unlimited supply of Bitcoin, because you can just keep taking a finite amount and cutting it into smaller pieces, unlimited. Yeah. And so again, it's like a stock split. With a stable coin, you're actually buying, you're basically using the dollar to consume online. So it has all the benefits of just not having transaction costs usually associated with it.
Yeah,
what the U.S. government could do, though, is rely on stable coins to finance the government, because these stable coins are buying U.S. treasuries.
Yeah. Well, I think our viewers are very interested in this. Just the term stable coin right now would seem, somewhat attractive to a lot of investors trying to understand how to maneuver through this marketplace. But let's go to our big topic, number 3. And this is another President Trump, eye-catching proposal. He's telling us about the EB-5 visa program, which is a green card for foreigners to come into
gold card.
the States.
A gold card. I love it. He called it the gold card.
It's a green card that's colored gold. So, can be purchased for up to $5 million and really gives a pathway to citizenship. So there's been a lot of talk about this week. Peter, what are your thoughts on this?
I mean, I think it's a great idea to raise money and to encourage some foreigners to come over to the U.S. These people will be vetted, so it's not just going to be anybody that writes a $5 million check that can do this. But it is a clever idea. Other countries have had similar programs where if you invest a certain amount of money, you can get a passport at the country. Portugal is an example. I know Italy has implemented the program. So I guess we would just be creating our form of it at a higher price point than some of these.
Can I ask Peter a stupid question? Having earned my way the painful way here, coming to college, getting the temporary green card, finding my wife, getting married, having my 3 kids, all of that. I believe that the other countries, it's just a threshold of investment into the country in order to get the card. When I read this, it looks like you pay $5 million, which is I don't know of a country that does it this way. Is it like the EB-5 where you have to invest in the country, or is it really the way I think it's been presented? You just give $5 million to the government and you get your green card. Do you know?
I don't think this idea was fully vetted out.
Fully baked.
So I don't think they themselves have all the details. And whether there's follow through, I guess we'll have to see. So
And I
I'm
think-
not sure, Joe, the
Yeah,
exact
and
answer.
I think though, Joe, I think you're probably right, but I think the assumption they're making is that people that have the means to pay $5 million to get in.
Yeah, they're very wealthy.
Well, they're going to attract entrepreneurs and they're going to
Sure.
build businesses. And look, it's like a lot of things these guys are talking about. You know, it's an interesting concept. I don't know if it's a terrible idea. The question is going to be the execution. You
Yeah.
know, how do they execute? You know, do they really vet? Are they the right people? But at the end of the day, if you're going to have people coming into the country, I think the one problem is going to be the question of fairness. That, you know, that the average person, you know, doesn't have $5 million. Is that fair? And what I would say is that, you know, not fair if there is such a word as fair, if the world were a fair place. But, you know, they're talking about raising $1 trillion, which seems like a pretty ridiculous number to me with the number of people they think would do this. But if they can get, you know, if they can vet people properly, and if they can raise a lot of capital and get, you know, wealthy entrepreneurs into the country, it might not be a terrible idea.
Can I ask a silly question? I mean, I assume if you're going to spend $5 million for just the right to come and work here, you must have $50 to $100 million, right? Like I assume. So if you have $50 million, is there any question that you can come live in the US? I mean, surely you can go buy a house, get a, like, I don't know, but I know I was making minimum wage, but I got to believe that there aren't many people with $100 million that can't live wherever they choose.
Right. But isn't it an interesting idea though, that they would come in? So then you're questioning then the idea, are there really that many people that would pay it?
Again, I just don't know. I mean, again, I'm just wondering what kind of person.
Yeah.
Well, I would have done whatever I could, but I didn't have that kind of money. So.
And you know, the best legal representation.
Yeah, of course.
And people with contacts. But
anyways,
I guess
that seems like a high threshold. That's all.
Yeah.
It's one thing, again, if it's an investment in the country, it seems to me an easy decision. Well, I invest $5 million and that I get.
Yeah.
I just, again, if it's just a check, that seems unusual.
Yeah. Yeah. Well,
so I think since you came to this country and, you know, really flourished in this country, you might want to give them some advice on how to handle the execution of this.
I wouldn't dare touch anything in the government. I'm frankly too direct and honest, probably.
Yeah,
I don't think you didn't want them to know that you exist. You want to stay away from these people.
Yeah. Well, Andy, is there any upside in terms of investment opportunity in this situation?
Yeah, I mean, look, as the volatility always creates opportunity, you know, so, and again, as I said before, there are always assets that are reasonably priced or even cheaper. You know, we've been talking for a while now that if people asked us a year ago, what are we afraid of? What keeps you up at night? We would say, and I give Peter more credit because he's my guru, but we were worried about stagflation. What we were worried about was the idea that inflation isn't going to dissipate as everybody hoped, as much as everybody hoped, that it would be stickier and higher. And that the growth prospects going forward might not be as good as everybody was hoping for because it was so concentrated. And if that happens, we like commodities. You know, oil prices are relatively cheap historically, and I know that they've sold off a little bit, although maybe up a little bit today. But you know, so we think energy, commodities we like. You know, again, international positions. We're not necessarily interested in indexing because we don't want to own all of it. But there are some really inexpensive. I mean, the most hated assets. I mean, Asia, you know, hasn't done anything for the last couple of years. You know, there's some funds that are trading at 8-9 times earnings, where obviously we're trading even now at much higher, earnings per share ratios. So yeah, there are some assets out there that do not look terribly expensive. You know, and I think a really well-managed healthcare portfolio. I mean, we're having a really good year. We're up 7.5% on our healthcare portfolio year to date in the first 6 weeks. So we're definitely finding some areas of opportunity. But people need to be really careful because what's happened in the last 10 years and what's made everybody so much money very likely will not be repeated the next 10 years, would be our view.
That's right. So I hear you saying have a plan, understand what you're investing in, and think about the long term. So. Makes sense. But now let's move on to a little bit more of our in-depth topic for the day. And then we'll get into our big 3 questions. But our topic today has to do with the certified financial planner, obviously near and dear to my heart. I'm on the CFP board. Andy's also a CFP, but it came out.
And we should say the chairperson-elect.
Yes.
So you're the queen of CFPs worldwide, which We're honored to share the stage with you.
Well, not exactly, but I am the chair-elect, and it's really a great organization. I'm very proud to lead that organization. But it came out with a really interesting study regarding who takes the lead in a partnership or a spousal situation on investment decisions in a household. So guys, I'd love to hear from you on this one.
Yeah.
Would you be surprised to hear, based on the CFP board study, that in more than 2/3 of households, like 2/3, it's women who are actually making those investment and financial planning decisions. And
And in 100% of households, the women get to either scold the man for making a mistake or correct their mistakes.
Right. Well, I mean, I am a little surprised by the Terri, but what I would say is this, that what I've observed over the last 40 years in my practice, that women are much, much more practical and much, I don't even want to say conservative, but they're just more thoughtful about investment processes, where men tend to be much more gamblers. They talk to their friends, somebody's making lots of money somewhere, and they just, I talk to men, and they'll make an investment. I'll ask the details of what they're doing, and they don't even really necessarily know, where women are much more thoughtful, I think, about their investment process. So
Terri, I totally agree, Andy. And again, this is a fraught subject because there are all kinds of men, there are all kinds of women. So we are generalizing here, but I will say an observation I have seen. Men lie about performance like they lie about other aspects of their life.
Right.
Like, I know which direction I'm going in. And women, in general, are more comfortable asking experts and using that to inform their decisions. It's like asking for directions. Like, I never want to stop and ask anyone. And my wife will, after the third wrong turn, say, when, Joe, are you going to stop and ask someone? Yeah. And so it's a parable. Again, this men are from Mars, women are from Venus. Again, we overlap a lot, but this is a really important thing, is what do you use? Using your slow brain or your fast brain to make investment decisions? And I think about it in the Daniel Kahneman, who's a Nobel laureate economist who I knew, was a professor at Berkeley for a while and invented something called behavioral economics, that men tend to make a lot of investment decisions with their fast brain instinct. Yeah. And that is fear and greed. Yeah. And women tend to make financial decisions with their slow brain. And in other words, their long-term conscious choices. And honestly, the difference between success and failure as an investor is whether you're using fast brain or slow brain. Do you use your twitch instinct, or you're actually thoughtfully building a plan? And so again, whether you're male or female, if you're making a decision instinctually rather than thoughtfully, you're probably going to make the wrong choice.
Yeah, I agree, Joe. And what the study found, and what we've talked a lot about on the show, is that women are very interested in long-term retirement planning, right? So they want to, because women are going to live longer than men. The facts are the facts. So they need to have a longer retirement plan. They also are the ones that are working on the emergency savings account. So they really believe in that concept of liquidity that we've talked about, at least 6 months. And then the last category is caring for others, right? Be it elder care, caring for their families, making sure they've got a plan to not only make sure they're okay, but their families are okay. And those would, follow along. And women really do want to work with a fiduciary. They have expressed that. And a fiduciary mean a CFP, or a fiduciary meaning we're doing it for the very best interest of the client, not just what's suitable, but what's in the very best interest. And so all of those do tick and tie to many of the things that we've talked about. Now, they don't necessarily need a male fiduciary or a female fiduciary, but they want a fiduciary. And that's what's important. But another really interesting fact that I'd love to get your guys' input is that newly married couples are keeping their financial accounts separate, believing that combining them could lead to more marital conflict. Well, I've been married for 31 years, and I do see some truth certainly in some of this. We had much more fights when we were younger than we do now. But what are your thoughts on combining accounts or keeping them separate? Andy, I'd love to hear your thoughts.
Well, I mean, so I was married when I was 22 years old. I've never had anything but joint accounts. But I think, though, that younger people today are less optimistic about the outcomes of marriages. It might be part of that. And look, there could be some practical reality to it. I mean, I don't know, what are the statistics? 50%, marriages fail.
Yep, that's
So
right.
it probably depends a little bit on the circumstances you come from. If you come from a family where mom and dad are married long-term, maybe you're a little bit more comfortable sharing. But I do notice with my younger clients, a lot of these clients have separate accounts, which, that's fine. I don't have I don't judge them for it. But my observation always is that maybe they know something that I don't know, and maybe they just think it'll be easier to exit if they keep things separate. But does seem to be the trend, though. It does seem to be the trend.
It's so interesting, Andy, because I just read this and then I read another article about newly married couples, and they have separate financial accounts, but they track each other on GPS. So they know exactly when they're at the grocery store.
Right.
They know where, when and where they're sleeping, if they're traveling to another
Sounds
state.
like trust issues, Terri.
Yeah. Yeah. So maybe next session we'll have a special on, marriages. Who knows?
Yeah.
But thank you guys. I really do appreciate your input on that. But now let's go to our viewers' questions. So as you know, we have questions from our viewers. So our very first one is from Donna from San Antonio, Texas, who is asking, retirement is a priority for her and her husband, but they don't want it at the cost of living life. And she's asking, can she do both? Can she enjoy life, and can she actually have a really lucrative, or at least an appropriate retirement plan? Andy, you want to start with that?
So, what we've been talking to clients about for years is set aside a certain amount of money to save, and then spend the rest. So if you can decide up front what the appropriate amount of money to save to accomplish your long-term retirement goal, then you can freely and happily spend everything else. And so to me, I think that the answer, it kind of depends on how much money they make. You can't spend all the money and be as happy as you want, do everything you want to do, and be able to save for retirement unless you make a lot of money. But what I will say, though, is sort of financially freeing and emotionally freeing is just figure out what that number is. Is it 10% of your income? Is it 5% of your income to get the outcome you want? And then spend the rest, enjoy it, to have no stress. Don't worry about whether it's something that's silly and frivolous or whether it's something that's necessary. And I think that's how I would approach that.
Terri, I wrote a book on this specific subject called The Money Code, and we did a lot of work on this. And there are a couple of things everyone should know are true for absolutely every human being. Number one is you will never be able to have everything that you want. So there will be trade-offs. Like, just know that no matter how wealthy you are, there's always another boat, there's always another house, or there's always the neighbors. Like, there will never be, because in America especially, how much is the perfect amount? A little bit more than I got. That's true of almost everything that is common of everybody in this country. So I would suggest, first of all, know that there will be trade-offs. This next big idea that was really true is how you make those trade-offs determine your entirety of your financial life. Albert Camus had the expression, life is the sum of your choices. If you don't have a really deliberate way of making those trade-offs, because having an advisor, their number one value is helping you make good choices. Of everything else, it's not outperforming the S&P. It's not getting better after tax returns. Believe it or not, if you have the right advisor, the right fiduciary, their primary job is to help you make better financial choices. And those are usually life choices, because money is tied to everything. So understanding that how I make choices, am I deliberate? Do I think about the long-term implications, whether I'm saving enough or spending enough? And then the third is that you have a deliberate action plan. You have discipline. Once you've made that decision, that you actually stick to it. And again, I hear all this stuff, stop spending on Starbucks and you'll get rich. That's just garbage. The truth is, life is short. You might get cancer tomorrow. None of it will matter. So there is a function. And what you'll see is a lot of people have their biases are, I do this all for security. They spend all their time trying to protect their money and no time enjoying it, and then they have a heart attack, and the kids have no problem spending it all, which would be a great topic of conversation for Andy and the team. But honestly, yes, it matters. Yes, you should do both. And yes, you should, depending on your income, depending on your goals, because you have other choices than how much you spend or save. You also have how long you work. You also have how big a safety net you want to leave behind. And all of these things interact. And that's what a great financial plan does, by the way. That's why you work with people like Andy and great advisors who will actually tell you these are the trade-offs you can make.
Yeah, you talk about those trade-offs, Joe, and there's always trade-offs, but you always want a little more, a little more, a little more. But there's no correlation to that little more beyond, maybe $100,000 to happiness, right? So
Right.
you want the money, but you also need some peace and happiness. And I know
That's
a financial planner can help people make that balanced decision. So let's go on to our second question, which is Judy from Miami. And she's saying that while she and her partner have similar financial goals, they have different thoughts on how to achieve them. And she's wondering, how can they reach their goals without constantly arguing? Andy, I feel like we're doing a little marriage counseling here, but help us out.
Well, I guess the first thing I would, if I were helping them, is try to understand what the differences are, because that's the place to start. But I have no idea, Terry, if I don't know what the context is.
Yeah.
I'll just share, Terry, we did some great behavioral economics. Money does one of three things. And we as human beings have a bias toward, if you think of it like three buckets, all that money can do, no matter what it is help you do things that bring you happiness, help to protect you, and help you to take care of the things you care about. So if you think about those three areas, that's every human thinks about, we all have a bias towards filling one of those buckets. So in a moment of stress, somebody in that relationship, and I'll give you my example of me and my wife, my bias is toward protecting because I grew up in Zimbabwe with nothing. My wife's bias is to enjoy life and take care of everyone around her. So she fills the other two buckets. We've been married for 32 years, and every fight's the same fight. She wants to host every party. She wants to pay for everyone. And I'll be like, hold on a minute. I'm not buying myself a new pair of shoes because I'm want to be prudent. And so that conflict, understanding which of your biases you're leaning on, and a good advisor, again, will understand we need to fill all three buckets. We all want to do the things that make us happy. We all want to protect ourselves from bad outcomes. And we all want to take care of the people we love and the causes we love. So that delicate balance, almost certainly, I think that should be able to answer the question by knowing which bias am I leaning to and which bias does my husband or spouse, assuming it's a husband, lean to as well. So you can end up finding the right mix.
And I think, Terry, I was in my conversation just a little while ago with a couple, and they were she likes to travel and spend money, and he seems more conservative. I think having both, though, is a good thing, because, it's not a good thing to be too much of a saver and to be too security minded, but it's not a good thing to be a spendthrift either. So what you try to do is sort of recognize that, guys, it's good that you guys aren't necessarily on the same exact page. What we have to figure out is a good combination or a good mix of both. So I would say that it's probably fine that they don't 100% agree. They just have to create a balance. And so that's not a bad thing.
Well, I think that's what's great about what Joe's saying too, is these behavioral economics or behavioral finance. It's kind of a big word, but all it really is just, what's your relationship with money and how do you make decisions? And oftentimes the two partners come from different views, right? A lot of our money habits are formed when we're children. And so it's bringing those together in a conversation with your advisor so you can get a path forward and achieve both sets of goals. So we have one more question, and this is Tara in Seattle. And she's saying she's about to get married. So her fiance wants her fiance wants her to merge her bank account, but he's a spender. So you've been in these scenarios before. Yeah. Well, she's a saver and she's worried about doing it. What would you advise her to do, Andy?
Well, I would say, look, if she's concerned about that, she should probably stick to her guns. Because if she doesn't, it's probably just going to create unnecessary conflict in an early marriage. So if that were my daughter, but first I would say congratulations on getting married and good luck. But I would say if one of my girls approached me with that, I would say, look, if that's something that you're concerned about, communication is fine, but I would say stick to your guns. And that'll be one less thing that will create conflict, hopefully in their early marriage. And then maybe she's misjudged it. And if he proves to be a responsible financial partner, then maybe they can merge accounts earlier. What you can't do is merge accounts, get the money spent and get the money back. That I know you can't do.
And Terry, honestly, the problem is in California, even if your accounts are separate, if you're married, you're liable anyway. So there's really no benefit to having.
I think she's worried about him spending the money, Joe.
Well, she'll spend. He can get credit cards. He can use the credit cards and should be liable for those credit cards. The reality is, I would take the time to just say, how are we going to think about our budget? Just have a grown up, we're married now, how are we going to talk about financial choices beyond, let's say, $100 or whatever the right number is? So, by the way, I will say there was a report, I think it was in the Journal of Consumer Research, that actually said that people who have joint accounts actually are happier and actually do better retirement planning. Not that she should join accounts with him, but she should at least be aware the difference of just because he can't access the account doesn't mean he can't spend money, and that she wouldn't be responsible for it anyway.
I bet they stay married longer too, Joe.
Yeah.
Yeah. Joe, you brought up a really good comment, though, in the state of California, which is a community property state. Everything is ultimately shared as a result of marriage or a 7-year partnership or beyond. Yeah. So our viewers, as they're making these decisions, know what state you're in and know what your actual laws are. And if you talk to an advisor, they can help you understand where the community property states are and what that means for you, not just in the short term, but for the long term. All right, let's move on to our big 3 stories for next week. And every week seems to be bringing in more and more stories, but we're really looking this week about the PCA that comes out tomorrow, which is a top indicator the Fed uses to measure inflation. Peter, what do you think the prediction is, and how do you think it's going to impact markets?
Well, the PCE usually comes out a few weeks after CPI and PPI. And because of that, it rarely deviates much from expectations. But because the Fed has said to us that they prefer that gauge rather than CPI, of course, the market's going to focus on it. So I don't expect any real difference relative to expectations. More yields have already come down. I still think the Fed is going to be in a sort of a difficult box here with juggling all the different macro factors that are taking place, particularly tariffs. I think more relevant for the market is going to be next week's payroll number, because if there's something that's going to get the Fed to cut interest rates again, it's going to be a rise in the unemployment rate, less so than a tenth lower on the inflation number. So that's the key. And earnings season's over, so the focus is going to be on the data next week and whether these tariffs on March 4th are going to get implemented or not.
Yeah, the jobs report is due next Friday, so we'll definitely be talking about that. But if we continue to see this volatility and clients are really getting nervous about their portfolios, Andy, what do you recommend?
Well, again, make sure you line up your liquidity. We can't time the market. And even, look, do we think there's a 10% correction out there? I mean, we've already seen some of that 10% correction in certain places, in certain individual stocks, for sure, more than that. But I would say that there's clearly a broader 10% or more correction out there, but that's normal anyway. And so again, I don't think people should, I just don't think people should be overly reactionary or try to time this market. I think they're going to.
No, there should be, in the history of the market, a 5 to 10% decline every 18 to 24 months.
Normal, exactly.
And a 15% decline every 2.5 to 3 years.
Yeah,
we haven't had that for a very long time.
We're overdue.
Just be ready for it.
Exactly.
And make sure that you're allocated right, you're rebalanced, so that you're going to be fine riding it out. And if you have doubts, have a great advisor who just helps to hold your hand.
Yeah, and I think, Terry, the one thing to think about, if someone just got their bonus or somebody just, walked, came into a lot of liquidity, a lot of cash, just be thoughtful about how you're investing that today. You might dollar cost average, put some in now, weigh yourself in, set some targets, that's all. But the idea of coming out of the market, I mean, look, there could be tax implications to come out. The thing too is, coming out of the market today, you might look really smart for 30 days, 60 days, but you might look really foolish a year from now. And so, because there is no signal to know when to come back. So yeah, we do not want to try to time the market. I think, patience, but you can be thoughtful about how you allocate fresh cash. I think that might be something for people to think about.
Yeah, I think you're right. If you do have some liquidity, you want to do it maybe in small doses and see what happens versus everything. Yeah. You guys, another really just interesting story coming out next week is, a lot of activists are out there talking about the DEI changes and the companies who have now dropped DEI or taken it out of their annual reports. And, some of these stores like Amazon, Target, Walmart, Nestle, they're reporting and, they're moving against DEI. Some activists are saying, okay, we're not going to purchase from you for a day and we're going to watch what happens to really show that consumer power. Peter, is that a good strategy or what are you thinking?
There'll always be some issue that somebody wants to protest against. And this is obviously a high profile one. I think companies want to hire the best people that they can find. They want to have the best business that they can run. And I think that's going to be their focus. And whatever color they are, whatever gender they are, companies are now focusing on finding the best people to carry out a particular job.
And we should just highlight, it is now illegal to use quotas, preferential. That is why it's given cover to a lot of companies that maybe didn't want to do it anyway, perhaps.
Right.
But regardless, as a former partner at Goldman who was there when we implemented a lot of these strategies, it's removed that and it's made it really a merit-based, because you have to legally make it merit-based. And so again, it's not leaving any choice. It's not like these boycotts or whatever they're going to do can be implemented, because it's actually now not legal to have any kind of vetting for race or any other filter.
That's right. Well, I'm looking forward to seeing these big
We had a long show today, Terry.
I know.
Yeah,
It
great.
must be me.
I don't know
must
if
be
anyone's
bringing
still watching, but hopefully they
the
are.
power of Gab back. But I found the conversation really interesting, and I'm looking forward to hearing your guys' view next week. But I want to thank all of our viewers for joining us. Again, we want your questions, we want your input, we want your feedback, what's working, what's not. But most importantly, we want you to achieve your financial goals. And we believe advisors out there like at Bleakley Financial Group, Andy and Peter and so on, they can really help you think through some of these. So if you're interested, go to Wealthion /free. We'll offer you a free portfolio review so we can get some of these questions answered and make sure you're feeling peace of mind for the rest of this year and beyond. So I want to thank Peter, Andy, Joe. Thank you so much for joining.
Thank you, Terry.
Thanks,
And
Terry.
thank
Great
you,
job.
guys.
Thanks.
Great to be here.
Be well.